Morning, my dear students. In this class, I'm going to explain about Indian tax structure. Tax structure in India is a three-tier federal structure. The central government, state governments, and local municipal bodies makes up this structure. According to the Article 256 of the Constitution, states that no tax shall be levied or collected except by the authority of the law. Each and every tax that is collected needs to be backed by an accompanying law. The tax system in India traces its origin to the prehistoric texts such as Arthashastra and Manusmriti. As proposed by these manuscripts, the taxes paid by farmers and artisans in that era would be in the form of agricultural produce, silver, or gold. Based on these texts, the foundation of the modern tax system in India was conceptualized by the Sir James Wilson during the British rule in India in the year 1860. Post independence, the newly established Indian government that solidifyed the system of propel the economic development of the country. After this period, the Indian tax structure has been subject to host of change. Source of public revenue. At present, the central government gets its revenue from three main sources. They are tax revenue, non-tax revenue, and capital receipts. What is this tax revenue? Let us know here. Taxes are the main source of revenue to the government. Tax revenue refers to the revenues collected from taxes. Tax is a compulsory payment made by the people to the government without expecting any quid pro quo relations. The central government mobilizes its tax revenue from two main sources. They are direct taxes and indirect taxes. So, what is direct tax? Taxes levied on the income and wealth of the people are called direct taxes. The direct tax, let us understand about the income tax, wealth tax, gift tax, and capital gains tax. Very first, let us know what is income tax. Income tax, which is known as personal income tax, is a tax levied by the central government on the incomes of individuals, Hindu undivided families, and unregistered firms and associations. Income tax brings second largest tax revenue to the central government. Second is wealth tax. Wealth tax is levied on the excess of net wealth over exemption of individuals, Hindu undivided families and companies. It was first introduced in 1957 on the recommendation of Professor Kaldor. It is not a very important source of revenue for the central government, and the yield from this tax is about 243 crores rupees during the period of 2006 and 7. Next is gift tax. Gift tax is levied on all donations and gifts except the ones given by the charitable institutions, government companies, and private companies. It was first introduced in the year 1958. Gift tax is progressive in nature. Now let us know the fourth one, capital gain tax. A capital gain tax is a tax on the profit realized on the sale of a non-inventory asset. The most common capital gains are released from the sale of stock, bonds, precious metals, real estate, and property, etc. Now let us know about indirect tax. Under that, value added tax, octroi tax, service tax, and customs duty. Before knowing this division of the tax of indirect tax, let us know what is indirect tax. The tax levied on the goods and services are called indirect taxes. Revenue from indirect taxation is the most important source of income for the central government. The principal indirect taxes levied by the union government are custom duties, excise duties, indirect taxes. Brings 47% of tax revenue to the central government. Very first, let us know the value added tax. That is a VAT. A sales tax levied on goods sold in the state. The rate depends on the government. Next, octroi tax. Levied on goods which move from one state to another. The rates depends on the state governments. Service tax. Government levies the tax on service providers. The next, customs duty. It is a tax levied on anything which is imported into India from a foreign nation. The three bodies which collect the taxes in India has clearly defined the rules on what type of taxes they are permitted to collect. The central government, that is income tax, custom duties, central excise duties. The state governments, tax on agricultural income, professional tax, value added tax, state excise duty, stamp duty, etc. Local bodies, property tax, water tax, other taxes on drainage and small services. The next one is GST, Goods and Service Tax. The government has introduced a constitution amendment bill in the Lok Sabha in March 2011 to operationalize the goods and service tax. It proposes to replace all indirect taxes by a GST, and it allows for levying GST on every transaction of supply of goods and services or both. In India, the three government bodies collected direct and indirect taxes until 1st July 2017. When the Goods and Services Act was implemented, GST incorporates many of the indirect taxes levied by states and the central government. Some of the taxes GST replaced includes like sales tax, central excise duty, entertainment tax, octroi, service tax and purchase. It is a multi-stage destination based tax. Multi-stage because it is levied on each stage of the supply chain, right from purchase of raw material to the sale of the finished product to the end consumer whenever there is value addition and each structure of ownership. Destination based because the final purchase is the place whose government can collect GST. If a fridge is manufactured in Delhi but sold in Mumbai, the Maharashtra government collects GST. A major benefit in the simplification of taxation in India for government bodies. GST has three components. CGST stands for Central Goods Service Act. The central government collects this tax on an instant supply of goods or services. SGST stands for State Goods and Service Tax. The state government collects this tax on an instant supply of goods or service. IGST stands for Integrated Goods and Service Tax. The central government collects this for interstate sale of goods or services, that is from Maharashtra to Karnataka. Other government bodies. For a smooth implementation of the Indian tax structure, there are bodies dedicated to it, popularly known as the revenue authorities. It is very first CBDT. The Central Board of Direct Tax is a part of the Revenue Department under the Ministry of Finance. It has a twofold role. One, it provides important ideas and inputs for planning and policy with regard to direct tax in India. Second, it assists the income tax department in the administration of direct taxes. So now let us know what is CBEC. CBEC stands for the Central Board of Excise and Custom deals with policy formulation with regard to levy and collection of customs and central excise duties and service tax. The next one is CBIC. Post GST implementation, the CBE has been renamed as the Central Board of Indirect Taxes and Customs, that is CBIC. The main role of CBIC in assisting the government in policy making matters related to GST. So my dear student, this is about the Indian tax structure with the division of direct and indirect taxes. Thank you.